Whenever budget season rolls around, we get flooded with high-level economic jargon from Islamabad, right? Fiscal deficits, trade imbalances, GDP ratios. It's a lot. But today, we're cutting through all that noise. We're keeping things simple and understandable. We're going to look directly at how the 2026-27 federal budget is actually going to impact the cash in your pocket, your daily living costs, and some new legal rules you definitely need to be aware of.
Because look, before we even touch on national deficits, we have to answer the biggest question on your mind right now. When you get that paycheck at the end of the month, is it going to be smaller? Well, the short answer is, it's a tightrope walk right now. The government desperately needs to collect record taxes, but the middle class is right at its breaking point.
So let's start with Section 1, the salaried class squeeze.
To really get to the heart of this, we need to see how the government views your monthly paycheck. 368 billion rupees. That is the exact, staggering amount of income tax contributed by the salaried class in the 2023-24 fiscal year. Since taxes are deducted right at the source, the salaried class is literally one of the most documented, compliant segments in the country. But that compliance? It comes with a massive burden. To put this in perspective for the common man, salaried workers paid roughly 257 billion rupees more than all the country's exporters and retailers combined. That is a gigantic fiscal contribution from everyday households that are already just trying to survive regular inflation.
And that reality sets up a massive behind-closed-doors tug-of-war in Islamabad. Our sources are actually showing two very different scenarios playing out. On one hand, you've got IMF pressures pushing to increase the tax-to-GDP ratio, which brings up proposals to hike the top tax slab to a punishing 38 to 40%. Ouch. But on the flip side, there are strong rumors of a 50 billion rupee relief package meant specifically for the middle class. That could potentially drop the 25% tax slab down to 20% for anyone earning up to 267,000 rupees a month. So it's really a waiting game right now to see who wins out in the final Finance Act.
Moving on to Section 2, the daily cost of living.
Let's move past direct income tax for a second, because even if your income tax stays exactly the same, your wallet is still going to take a hit through indirect taxes. Budget proposals directly inflate your daily expenses before any tax is even deducted from your salary. It's this phenomenon called cost-push inflation. Basically, when the government hikes the petroleum levy, which hit an absolutely massive 117.4 rupees per liter in May, it creates a domino effect. Diesel is the backbone of freight transport and agriculture, right? So fuel goes up, and suddenly transport inflation skyrockets to almost 37%. And when moving goods is that expensive, the price of your groceries, clothes, everything just goes up. It's not that people are buying more, it's literally just that moving the stuff has become incredibly expensive.
Then we have direct taxes on consumer goods. Whether you're trying to escape our unpredictable power grid by installing solar panels, or you're just looking to buy a new smartphone without totally draining your savings, these uniform taxes are going to drastically increase your out-of-pocket costs. For instance, slapping an 18% general sales tax on solar panels could bump the cost of a standard 5-kilowatt system by up to 140,000 rupees. That pushes your payback period from 3 years to 5. Meanwhile, luxury mobile phones might see a 25% duty plus a fixed levy, which is basically a move designed to push everyone toward locally assembled devices.
All right, Section 3, FBR notices and legal traps. The absolutely crucial takeaway here is that this budget isn't just about pump prices or grocery bills. It's about a massive, sweeping push for documentation that could legally trip you up. The government wants to know exactly where the money is moving. Now, if you receive an FBR notice, do not panic, but absolutely do not ignore it. An FBR notice is a formal legal inquiry demanding you explain mismatched financial records. Our legal sources stress that your very first reply shapes the entire trajectory of the case. FBR disputes are document-driven, not emotion-driven. They want hard evidence, not excuses, so keeping your records clean is literally your best defense.
Because honestly, it's everyday financial habits that can suddenly turn into legal risks. Let's say you've got a regular taxed salary, but you also run a side hustle or do some freelance work, and those extra earnings drop straight into your normal bank account. Well, if your tax return claims you make one amount, but your bank deposits show a much higher amount, boom! That mismatch is exactly what triggers a red flag and gets you an FBR notice. It's such a simple mistake for the common man to make, but it is a legally costly one.
And if you're involved in real estate, you really need to pay close attention here. Under Section 236K, non-filers are essentially being frozen out of the formal property market. You could be totally restricted from registering or transferring property, period. On top of that, the holding period for capital gains tax might extend from 6 years all the way up to 10 years. So for anyone buying or selling real estate or overseas Pakistanis sending remittances home to manage assets, these new restrictions make property transactions incredibly risky and super expensive if your paperwork isn't absolutely flawless.
Which brings us to Section 4, the shadow economy explained. To really grasp why the government is leaning so heavily on you, the documented, salaried, compliant taxpayer, we have to zoom out and look at the macro problem. Why is the net so tight? It's the informal economy. This is the shadow sector where cash just changes hands without receipts, totally outside the tax office's reach, and it's estimated to be worth a staggering $457 billion. Just think about that. That's roughly 64% larger than the documented formal economy, which sits at $340 billion, that is actually paying the country's bills. Millions of businesses are choosing to stay informal simply because the cost and red tape of doing things by the book are just too high.
And the business community, through the Federation of Pakistan Chambers of Commerce and Industry, is impartially pointing out that squeezing that tiny formal labor force has reached a breaking point. They're urging a major structural shift to go after and tax those informal giants rather than just endlessly punishing the people who are already doing the right thing. Because right now the current system is actively forcing closures in manufacturing and just pushing even more economic activity underground.
Let's look at Section 5, smart moves to prepare.
Okay, so what can you actually do right now to protect your wallet and stay out of legal trouble before these new rules kick in? Well, by following a few simple steps immediately, you can dodge the harshest penalties. Number 1, if you aren't already, get registered as an FBR filer. You want to avoid those severe non-filer restrictions at all costs. Number 2, pull up your bank statements and make sure they logically match your declared income. If you have a side hustle, do yourself a favor and do not mix your business and personal accounts. And number 3, if you're in the middle of a property transaction, do whatever you can to complete your mutations and paperwork before the new fiscal year officially begins on June 30th.
So, as we wait for the final budget implementation, this is the vital question we all really need to be asking ourselves. Are we building an economy that rewards the honest taxpayer or one that punishes them? Will the 2026-27 budget finally broaden the net to capture that massive shadow economy? Or is it just going to squeeze the common, documented citizen even harder? It is a super delicate balance of policy.